Afternoon, everyone. Welcome to today's FOMC fundamental prep. Obviously, a bit of a change this time round. Normally, myself and Brannigan do it, but he's sunning himself in South Africa somewhere, so it will just be me for today. But hopefully, the quality will be no less. Okay, so potentially this FOMC could be massive in terms of maybe that we'll get the first rate hike that we've had for over 9 years from the Fed. So it will be eagerly watched, eagerly anticipated, both from traders, analysts, and the general public alike. So in terms of today, what I'm going to go through, first start as per normal with the meeting format, then go through briefly the Fed mandate, talk about what happened at the previous meeting, which was in October, referring to the statement, the minutes, the market reactions, and well, actually we won't have a video price ladder due to some technical difficulties. Then I'll go through the data since the previous meeting, what's priced in and from the stir markets and the expectations, and then some key focus points and things we need to look out for. So, sorry, just 1 second. Okay, so the format of the meeting, it's tomorrow. They're actually meeting today and tomorrow, but the outcomes are all tomorrow. And at 7 p.m. BST or 2 o'clock Eastern Time, we'll get the announcement of any change in the Fed funds rate, the announcement of any QE or tapering. Obviously, that's not expected. A release of the statement. Now, in terms of the statement, that will be generally just a screen dump on Reuters, Bloomberg, however you want to get it, and it gets released immediately on the FOMC website, the Federal Reserve website rather. But obviously, for our purposes as traders, we should just tune in and plug in the words to Reuters that we really want to look out for and pay attention to. We'll also get at 7 o'clock the updated summary of economic projections, so essentially the dots as well as the projections for inflation, growth, and employment. And then one thing new that we could get, which we don't normally get, and this will really only happen if we do get the rate rise that's anticipated, is an implementation note. And now this will actually detail the specific measures the FOMC will use to implement policy changes. So if in fact they do change policy tomorrow, then an implementation note will be published. Now, how they change policy we'll go into a little bit later. A rate rise is expected. Now, if they raise rates, obviously we talk about changing the Fed funds rates, but there are some other rates as well that they will move around, and it's important not to get confused with what those rates actually are. So, but that I'll go into a bit later on today. And then tomorrow at 7:30 we get a press conference from Yellen and a Q&A. Now, we don't get that at every meeting, it's generally every other meeting, and this is one of those meetings where we will get a Yellen press conference and Q&A. Okay, so the Fed's mandate to support continued progress towards maximum employment and price stability. So essentially, inflation and employment is their dual mandate. It has been for quite some time. In the past, they only had an employment mandate. In the last year or two, they brought an inflation stroke price stability mandate as well. So that's what we'll be focusing on. What happened in the October meeting? So rates were unchanged, as we all should know. The vote was 9-1 with Lacker dissenting again. He actually wanted a rate hike at that meeting. Other key takeaways: the US economy expanded at a moderate pace. Inflation continues to run below target. But now the most important ones, I think, from the last meeting were what I've highlighted in yellow. So there was a removal of a reference to global developments, maybe restraining growth. If we recall from the September meeting, the market was priced 50-50 whether they'd hike rates or not, and the Fed and Yellen put great emphasis on the global developments. There was weakness in the emerging markets. Chinese equities and the currency had taken a turn for the worse, and we didn't really know how that would feed into financial markets, and the Fed were a bit uncertain. So that's what prevented a rate hike in September, and in October they essentially removed the reference to that which essentially was taken as very hawkish. Additionally, in yellow again, what else was particularly important is that the Fed said they will determine if rates can be raised at its next meeting. So they're very explicit in terms of referring to December, so at its next meeting, versus how long to determine the target range for. So that was also taken as very hawkish from the markets. And those things highlighted in yellow were the key takeaways from the last meeting. Obviously, they mentioned the same old stuff with regard to rates lift-off tied to job gains and inflation confidence. They also mentioned labour markets lacked to diminish since the start of the year, but that's nothing new, if I'm honest with you, and it's really those points in yellow that were important. So if we summarise the last few months, the outcomes of the Fed in April, essentially they were data dependent. In June, they'd been data dependent. In September, they were still data dependent, but with the greater emphasis on global markets, markets, China and the dollar. In October, they went back to being data dependent, and well, December tomorrow, I guess we'll see if the data has warranted a rate hike from the Fed. Okay, so the market reaction last time round, I did want to play a video, but like I said earlier, we couldn't for technical reasons. But if we look at the stirs first of all, the reaction in the stirs was fairly dramatic, with popular carry trades being unwound, long carry trades, and the Eurodollars were hit hard and aggressively sold on the reference to its next meeting. So if I just bring a chart up here, we saw actually, so the meeting was on the 28th of December, so this is the March Eurodollar futures, went from 99.03 essentially to change on the day 99.90, which is 13 basis points higher in yield, lower in price, 26 ticks. But ever since then, we've gradually ground down and lower and lower and lower before stabilizing over the last month or so within a tighter range. But essentially, it was a shift, a massive shift from the Fed. The market took note that rate hikes were coming, that they were very likely to come at this current meeting in December, and the short end sold off, and we've never got even close to those starting levels since. So that was very important from that perspective, from the stirs. Now in the bonds, we saw a similar sort of reaction with aggressive selling. The Treasury curve bear flattened very aggressively. The 2-year, 3 to 5 year yields were also higher, 10 basis points higher. The long end, it dipped initially, but then there was good buying into it, and probably magnifies the flattening that we saw, and because basically the flows after the initial repricing were much better buying across the curve. So if we get a chart back of the bonds, we see the top one here is the 5-year yield. Like with the stirs, essentially where we have the red line is the 28th of October. Like with the stirs, bounce in yields from 130, just under 136, to close the day at 147, and then yields have ground higher since, and then stabilized within kind of a 160 to 170 range, but starting from 135. And again, we've never seen these yields ever since that October FOMC. And same with the yield curve. This is a 5s 10s chart here. We flattened ever since. So October FOMC, we were at 64 basis points. Now the 5s 10s is at 57, got as low as 55. But again, we haven't seen the curve steepen up to anywhere near the pre-October FOMC levels. Now with the equities on the release last time round, it was a little bit different. So this is a 1-minute chart this time round as opposed to a daily chart. The S&P knee-jerk reaction lower, quite aggressive selling on the hawkish sentiment, the hawkish rhetoric from the Fed, and we dropped essentially about 25 handles in the, well, initially probably about 20 handles in the space of 2-3 minutes, dropped another 10 handles or so, but then we rallied back to unchanged pretty much over the next hour, and then equities actually ended up higher on the day. Now why did they do that? Because pretty much, okay, it was hawkish from the Fed, but the kind of one and done kind of scenario came into a lot of investors and traders' minds, that the pace will still be slow when the Fed do move, especially given the easing around the rest of the world. And finally, on the back of the last meeting, the dollar. This is the euro dollar 1 minute chart. Again, as you'd expect, the dollar strengthened quite dramatically. This is, so in terms of this chart, it's euro dollar, so the euro dollar goes down in the first minute about 100 pips or so, continued for the next 10-15 minutes, another 100 pips, and then kind of stabilized within a tight range. So essentially 2 points lower in the euro dollar on the reaction to the last FOMC. Okay, so that's what happened last time. So the Fed have said again and numerous times that they're data dependent. So it's important for us to look at the data over the past month, and being a inflation and employment targeting central bank, the NFP, the non-farm payrolls, was very important, and the market really paid close attention to it. Now we've had 2 non-farm payrolls prints since the October meeting. In November we got a very, very strong payrolls beat, 271,000 versus 185,000 expected. Average hourly earnings, which is often emphasized by the Fed as it feeds into inflation, came in at 0.4% versus 0.2% expected, and the unemployment rate held steady at 5%. Then in December, we got more solid numbers, not quite as good as the previous month, but solid nevertheless. Payrolls coming at 211,000, average hourly earnings 0.2%, and the unemployment rate at 5%. So these were all around consensus. And if I just show a chart of what these have been doing, so at the top is non-farm payrolls, and you see we've generally been around the 200k mark for quite some time now. The employment part of the mandate, it really has stabilized and has been doing pretty well. This spike here in on the November report and back to where it had been previously. Average hourly earnings again spiked to 0.4%, been there a few times, but essentially fairly stable around the 0.2% mark. And the unemployment rate, actually we've seen for quite some time a steady decline in the unemployment rate, down to 5% from, if we go back as far as the financial crisis, close to 10%. But essentially it was only a year or two ago that the Fed were talking about 6.5% as being the rate, what they want to see before rate hikes come. Now we're well below that, and that's kind of when the Fed went from their employment mandate to a dual employment stroke inflation mandate. Other data, PMI manufacturing slightly weaker over the last month, but nothing really to pay too much attention to. Inflation measures, core CPI and core PCE. Obviously we had CPI today, 2% year on year versus expected 2%. Now the Fed have often talked about inflation heading back to 2% in the medium term. And looking at the core CPI, well, you'd say maybe we're there, but actually the Fed's preferred measure of inflation is the PCE, and the last print on that was 1.3% year on year versus 1.4%. So still not quite where the Fed want it to be, but the signs have been positive, and obviously it's the medium term inflation outlook that they're looking at. They're looking to get it towards 2% in the medium term. In terms of other figures, retail sales been ambling along 0.2% versus as expected, and GDP preliminary GDP has been slightly stronger than expected last month, coming in at 2.1% versus 2% expected. With all that, the oil and the dollar, I know it's not data as such, but that's been something the Fed have been mentioning in the past, and because they've mentioned it, we obviously have to pay attention. So if we look firstly at oil, actually let's get a daily chart up, show a bit better. Yes, so oil, since the last Fed meeting we were around here, and oil has been at its lows in the last couple of days, bounced in been at its lows at the end of yesterday, bounced a little bit today, but ultimately the oil prices are a lot lower than where we were last time around when the last FOMC meeting took place. Now, the Fed have often talked about oil not being a major issue because it's transitory, it feeds into inflation in the short term, prices go down, yes, but actually it could be a positive for growth in the medium to longer term. And that still seems to be the case because most of the oil price reductions have been supply led. Now, if it deems that maybe some of the weakness in oil is not supply led but actually demand led, then that will cause more of a problem. Maybe weaker demand from China, etc., etc. But by and large, it seems that the transitory effects are still there. It still seems supply led, so I don't think that will influence the Fed too much. Now, if we look at the dollar, since the last meeting, yes, we rallied. This is the dollar index. We've rallied quite significantly, maybe 3% initially in a couple of weeks after the meeting, but then have actually come off since, and we're not actually that much higher than where we were prior to the last FOMC meeting. And finally, the FOMC minutes from October didn't really give too much away. Nothing new, to be honest. It was pretty much a non-event, and hence why I won't really talk about it too much. Okay, so if we look at the dot plot, and we'll look at this in the context of going on to market pricing. So if we look at the June 15 dot plot versus the September dot plot, what we saw in September was dots downgraded, and we're still expecting the rate hike from the Fed. Most members still saw it there. That was interesting that one was actually called for negative rates come the end of the year, probably Kokolokota. Kokolokota's not voting anymore, but generally the majority of members expected, as per the dots, a rate hike this year. And now obviously this particular meeting is the last time we'll be able to see that, or the last time it will be able to materialize. Okay, so market pricing. The current Fed funds target rate is 0 to 25 basis points, with the current rate actually being at 14 basis points. Now, it's generally in a band. Typically, in the last few months, the rate has fixed between 12 to 14 basis points, even though the band is 25 basis points wide. In terms of what the market's pricing, it's a 72% chance of a hike for this December meeting. Now, depending on what you read, you'll get different numbers. So when I say 72%, I'm saying 72% chance of a 25 basis point hike. Now, there has been some analysts actually mentioning that the band, yes, it will be shifted maybe from 25 to 50 basis points, but actually the effective Fed funds rate may be only going from 14 to 34, so that's only 20 basis points because the whole hike might not be passed through. So that's why I'm saying 72%. Other things you read might have 90 odd percent, but either way, it's pretty heavily priced, and it would be a real outlier if the rate hike wasn't delivered. In terms of when it's fully priced, the first hike is fully priced for January. So if we look at the current market pricing, 32.32% for December, pretty much slam dunk rate hike. Current Fed dots are slightly higher than that, but there hasn't been such a close consensus for a long time. We've seen disconnects between the Fed and the market for a long time, and while it still persists in longer dates, December 16, December 17, you can see over 50 point differential there, over 120, 130 point differential there. The differential for tomorrow's meeting is pretty much non-existent, and as we saw in October, the market was only pricing 0.2 Fed funds rate, so we're a lot higher now and a lot closer to the Fed median dots. So essentially, what we're seeing in terms of market pricing is the rate hike is priced, but the market expects a slower pace of rate hikes going forward than the current Fed dots would imply. Obviously, we're getting new Fed dots. These Fed dots are from September, so likely to change. Okay, so some key focus points that I really think we need to pay attention to, and these are the 5 main things I think the Fed will be considering and reflecting on at the meeting tomorrow. So firstly, the Fed funds rate announcement. Then they will update the dots. In conjunction with the dots, there's the summary of economic projections, but to be honest, it's the dots that will be the most important within them. The economic outlook will be touched upon. The language and forward guidance will be very important for us to focus on, and also the global outlook. So the Fed funds rate, and in blue on these slides I've put where they should come up. So the Fed funds rate will be ultimately a rate announcement, and in the statement is where you might find any rhetoric regarding it. So last time around they said, in determining whether it will be appropriate to raise the target range at its next meeting, the committee will assess progress both realized and expected towards its objective of maximum employment and 2% inflation. Additionally, they said it's appropriate to raise the target range for the federal funds rate when it sees some further improvement in the labour market and is reasonably confident that inflation will move back to its 2% objective over the medium term. So, 2 scenarios: rate hike, no rate hike. So the Fed will essentially hike rates if they believe the above conditions have been met, their employment and inflation mandates, and as we said, the Stern market is pricing a 72% chance of that 25-point rate hike. But obviously, if they move it only, if it's only 20 points higher, then it's pretty much fully priced. Unchanged rates, unlikely. It's a minority view, but this will occur if the Fed believe the domestic economic outlook and or international developments are more uncertain. Obviously, in the last week or so, we've had weakness in China, depreciation of the yuan, weakness in the emerging markets, weak equity markets. Will that tilt them? Will that tip them over the edge and stop them from hiking rates? I doubt it. But you know that has been a reason why they haven't hiked rates in the past. But in the past, in September, when they touched upon these, the market was not pricing a rate hike like it is today. So in terms of that, the market will definitely react quite heavily if they don't deliver. Now, as I mentioned at the start, if they do hike rates, there are a few mechanics that we really need to be aware of and really pay attention to, and it's really important, and I can't reiterate enough how important this is, that we don't get confused when the Squawk, when Reuters is mentioning various different interest rates. Obviously, the main interest rate that we look at and the Fed talk about is the Fed funds rate, and this is and the expectation is to raise it to 0.25, to the band of 0.25 to 0.5%, up from 0 to 0.25%. But in conjunction with that, you will hear other terms about the interest paid on excess reserves. You'll hear about the Fed's overnight reverse repurchase facility. You'll hear about the discount rate. You'll hear about the Fed effective rate. And it's really important that you don't confuse yourselves with what's going on. Know what these rates are. Know what the Fed funds rates is. Know what the interest on excess reserves are. Know what the the discount rate is. Because, for example, if you hear the discount rate's been hiked to 1% and you think rate hike 1%, actually you're interpreting it all wrong, because actually the Fed funds rate is not hiked to 1%. So it's really important that you know what the target rate is, what the Fed is actually referring to. So obviously, we've been talking about the Fed funds rate for the last months, years, and that's generally what the main tool is that the Fed use, and that is what is expected to be hiked 25 basis points, the band to be 25 basis points higher, from not to 0.25% to 0.25% to 0.5%. Now, in conjunction with that, what they will probably do is raise the IOER. So this is the interest rate paid to banks on excess reserves held at the Fed, and this is expected to move from 0.25% to 0.5%, which essentially will be the top of the new target range for the Fed fund. So important to be aware of. If you hear IOER raised to 0.5%, it's not the Fed funds rate being raised to 0.5%, it's something else. By the same token, you might hear that the overnight RRP has been raised. So this is the offered rate on the Fed's overnight reverse repurchase facility. That's currently at 0.05%, and it's expected to go to 0.25%, which will be the new bottom of the Fed funds target range. So again, be aware, if you hear this RRP being raised to 0.25%, that's not the Fed funds rate. Because actually, if the Fed funds rate was raised to 0.25%, that is actually less than is expected. Additionally, I'll just jump ahead a little bit. The discount rate, that essentially is the loans to eligible depository institutions through the discount window. So essentially, to the actual Federal Reserve banks themselves, the New York Fed, the Michigan Fed, the Milwaukee Fed, and the rest of it. So this is likely to rise as well, for 25 basis points. So it's currently 0.75%. That's expected to rise to 1%. So again, I reiterate again and again and again, if you hear rate hike to 1%, the chances are it's not the Fed funds rate. But so be listening, be clear, have clarity in your thoughts about what you're paying attention to. The Fed funds rate is the one we've been talking about there, but there likely will be other rates moved, and that will be in the additional statement that's released in conjunction with the Fed statement at 7 o'clock. So I did mention this earlier. Many banks expect the Fed funds rate to settle around 32 to 34 basis points if they hike rates. So basically 20 basis points of the 25 hike to be passed on rather. And this will essentially be due to the high level of excess liquidity in the current system. So even though the band might be raised 25 basis points from the Fed funds band, that is from 0 to a quarter to a half, what's actually passed through in the Fed funds rate might not be 0.25% at all. It might not be 25 basis points. It might only be 20 basis points. So important to be aware of all of these quirks, really, because obviously the bulk of us haven't seen rate hikes from the Fed. They haven't hiked rates for 9 years. So it's important to know this stuff, and once you know it once, you won't really need to go through it again. And also, a final little point, any rate change will take effect from Thursday the 17th of December, so the day after the rate hike. That's when it takes place. Okay, so we've been through potential for rate hikes. The updated dots. So the dots are expected to be unchanged to small lower. 2016 dot is currently at 1.375%. Should stay the same. 2017 and 18 expected to be lowered by 0.25%. Now, we also probably will get a 2015 dot, but this is pretty much redundant given this is the last meeting, because essentially doesn't really matter what the dot says, because the Fed will either do something or not do something. But it might provide some information on how strong a majority we have, how many of the participants and members were looking for the rate hike and wanted the rate hike. So we might see how strong the consensus is, I guess. Scenario analysis, we always talk about this. What if the 2016 dots are lower? So they could be lowered in conjunction with a rate hike, and this indicates a dovish hike. Now the market is expecting a dovish hike to have, they've often talked about slow, gradual rate rises, maybe not the one and done scenario, but the market and the Fed have talked about a very balanced pace of rate hikes. So if we do have a lowered dot for 2016 in conjunction with a rate hike, it does indicate a slightly dovish hike, and probably what the market is expecting. Now if it's lowered in conjunction with no rate hike, this will be an extremely dovish outlier, and really the market has discounted this, to be honest, and we'll get some pretty massive moves if we don't get a rate hike, and especially if and it will be super dovish. So we'll probably get some great opportunities if this happens at 7 o'clock, but also the statement in the press conference will be huge, as to get explanations for it. Obviously it's not a base case scenario, but one we need to prep for nevertheless. If the 2016 dots are unchanged, then we still see the disconnect between the Fed and the market persisting. Obviously we talked about it closing for this current meeting, but for 2016 and 17, still there, so the disconnect will still remain in all likelihood. Maybe it will close a little bit, but the market's not expecting it. But also remember to know that the median projection could be unchanged, even though a number of officials may lower their forecast. So if we go back to the dot plot for September, for 2016, we're looking at quite a wide range of from under 1% to 3% of what participants see by the end of the year. So the median is 0.1625%. Now even if a couple drop lower their forecast, the median could still remain there. So it's important to look at the composition as well, even if the dots don't actually change. Okay, and the 2017-18 dots is not really a significant focus at this meeting, but it's expected to be lowered very slightly. Now, then, onto the economic outlook. So what are we looking at there? Where are we looking? We're looking at in the summary of economic projections, we're looking at it in the statement, we're looking at the press conference, we're looking at it in the Q&A. So there are 4 potential places where we could get some information about this. So we talked about inflation being policy mandate. So has the medium-term inflation outlook changed? And the 2017 one will be the important one. As we mentioned earlier, PCE is the main measure that the Fed look at, and that's currently at 1.9% in terms of their projection for 2017. Will that get upgraded? Will that get downgraded? That's something to watch out for. Now, in terms of the statement, last time it was mentioned, inflation is anticipated to remain near its low level in the near term. Does that change? Will we see a change in the statement? Maybe if they hike rates, maybe they don't. Maybe they don't think it's such a problem, but the committee expects inflation to rise gradually towards 2% over the medium term. Now, this essentially, if they hike rates, this should be reiterated anyway, because they shouldn't hike rates if they don't believe this. Employment. This is a bit of a typo, but we had a much stronger than expected NFP. I mean, does that derail? I guess it shouldn't derail at all, but does that re-emphasize the employment outlook from the Fed? So last time around, in October, they said the pace of job gains slowed and the unemployment rate held steady. Now, obviously, we've seen with the recent payrolls number, the pace of job gains has picked up again. The unemployment rate is still at 5%, so it's improved. And last time around, they said labour market indicators on balance show that the underutilization of labour resources has diminished since early this year. Yes, I mean, again, we've had some strong data since then, so this shouldn't really be a problem to the Fed. And in terms of growth, it's not a mandate as such, but they've been saying for a while economic activity has been expanding at a moderate pace. I don't think this will change. But obviously, if these things do change, then we could see some movement in the markets. But it really has been, employment's been where they've wanted it to be for a while, growth's been ticking along. It really is this inflation aspect that we should pay attention to in terms of the economic outlook. Then the language and forward guidance, where will we get indicators of this? Well, in the statement, in the press conference, and in the Q&A. So in the last statement in October, obviously in October there was only a statement, there was no press conference, so they said in determining whether it will be appropriate to raise the target range at its next meeting, and the real focus was at its next meeting. As we mentioned earlier, they'd never explicitly referred to it about any individual meeting, so at its next meeting it essentially refers to the December meeting. They also said appropriate to raise rates once we're reasonably confident that inflation will be moved back to its 2% objective over the medium term. So these are probably the 2 key things to look out for in terms of the forward guidance. Now, we're looking at Fed liftoff potentially, so that we're looking at rhetoric regarding that. So that's only important if there's no hike. If there's no hike, then we want to know when that hike might come. But obviously, It's an outlier event, but if it does happen, if the hike doesn't come, rather, then we'll be concerned with the forward guidance as to when the hike will happen. Probably more important, well, probably not so much more important, but more our focus, because the rate hike is pretty much priced, will be the Fed pace. Now, they've talked about being balanced in their approach to hiking rates. In the past, they've used terms such as measured pace, gradual normalization, very gradual. FOMC members have emphasized rate increases to be slow and gradual, but we haven't had a buzzword like we did with Greenspan, for example, when they talked about measured pace. Rate rises would be measured, which measured to Greenspan at that time of the last hiking cycle was essentially 25 basis points at every meeting. Now, will the Fed commit themselves or pre-commit themselves to anything? Probably not, but something to look out for in the statement, and no doubt Yellen will be quizzed about it in the press conference and the Q&A. In terms of the forward guidance, I expect them continued emphasis on data dependency, and that be irrespective of the rate decision. The Fed and Yellen in particular have often talked about data dependency as opposed to calendar dependency. The timing is not that important. The rate hikes will come when the data warrants it. So I don't expect that to change. Will there be any changes to future press conferences? Analysts in the past have suggested the Fed might hold press conference after every meeting going forward, and this could be a signal for future hikes, or that every meeting is live. So again, it's not something that's been talked about recently too much, but something that could potentially provide some forward guidance as to every meeting being live. And then balancing a hike or no hike with a dovish or hawkish tone. We've talked about the dovish hike, which is what the market's expecting. The rate hike with with a fairly dovish Yellen, indicating that rate hikes will be gradual and there's no rush, etc., etc. So if there's anything aside from that, obviously the no hike will create an opportunity for us. A hike with a hawkish tone will create opportunity for us. The hike with a dovish tone, obviously there will be some opportunity, but probably not as much with the others. But these are the sort of things we should be looking in the language and the forward guidance. And as I said earlier, this could come up in the statement, the press conference, or the Q&A. And finally, the forward guidance regarding the global outlook. And I've dedicated a slide especially to that because it was pretty important in the September meeting. In the September meeting, they actually said the outlook abroad appears to have become more uncertain of late. Heightened concerns about growth in China and other emerging markets have led to volatility in financial markets. And basically, this was in September why they didn't hike rates. In October, they said they essentially omitted this, but just said monitoring global economic and financial developments. So we've seen, why are we looking at this now? Because there has been a bit of volatility in global markets since the last meeting, and more so in the last couple of weeks. China, for example, we've seen depreciation in the yuan, and the lingering growth slowdown in China. Will that affect the Fed? I think it shouldn't do this time round. They've used it as an excuse in the past. I don't think the volatility this time round has been quite the same as it was when we saw these quite extreme moves in August. But nevertheless, it could be something that surprises us and may influence the Fed. Emerging markets are weaker. The dollar is stronger, although as we showed from the chart last time, looking at the dollar index, we showed the euro dollar last time, but the dollar index, what has actually happened since the last meeting? Yes, the dollar strengthened quite significantly, about 3%, but has actually pulled back and is not that much. It's pretty much the same as where it was last meeting. So the dollar strength, yes, it's a concern potentially, but it's not concern. It's not a concern in the sense of the dollar being strong, but it's the implications it can have for growth and inflation. Because a strong dollar with weak global demand imports disinflation, and obviously, inflation is the indicator that the Fed have been most concerned about. If we look at US equities very quickly, they've weakened in December, and more so in the last couple of weeks. But if we look at an S&P chart, so this was the October meeting. In the last couple of weeks, we've weakened quite a bit in global equities, and represented by the S&P. But actually, where we are now is not that much lower to where we were in October at the time of the last meeting. Yes, we've been lower. We've bounced yesterday, bounced a bit today, and we have seen a bit of a downward trend, but we have bounced and not much lower than where we were prior. So the volatility in equity markets, the weak equity markets, shouldn't really come into it, but something we should still nevertheless just be aware of what's been going on, and how equities have been moving. Oil and commodities, talked about this earlier, they're weak, and although they're off their lows, it could feed into lower inflation, especially if the recent fall is demand driven. The Fed have talked about oil price drop, commodity prices being a transitory effect on inflation, but actually it's only going to be a transitory effect if it's a supply led effect. If it's demand driven, it's no longer transitory. If the demand is weak because emerging markets aren't demanding, China is slowing down and hence aren't demanding these commodities, then it's a problem. Now I don't think at this stage the Fed is going to talk about it being too demand driven. I think they'll go along the lines of it still being transitory and supply led, but again, something to be aware of. If it's demand driven, it could be a problem, and not necessarily in just the context of tomorrow's potential rate hike, but in the future, the path of rate hikes. So it's really important to be aware of that. And then finally, the US economy is the exception as opposed to the norm. There's monetary easing all over the world. The ECB earlier this month embarked on an extension of their QE package. We've seen rate cuts from New Zealand. We've seen rate cuts from Australia in the last few months. We've seen increased QE from Japan. We've seen rate cuts from Canada. We've seen rate cuts all over the world. It's only really the US that is in a position of, at least in the developed economy, hiking rates. So it is the exception as opposed to the norm. Will that prevent them? No, it won't. But obviously, with the global easing all over the world, it might lead to them, being cautious about further rate hikes, and the pace at which they do things going forward. Okay, I've covered pretty much what I wanted to cover. Apologies if it was a little bit longer, but I feel given that we could be seeing the first rate hike for over 9 years from the Fed, the biggest central bank in the world, I think it's really important that we do have this fundamental background and this fundamental appreciation of exactly what's going on. And I think we've been through a lot of this in the past, but I think if there is really something that you do need to focus on that we don't normally cover, it is the mechanics of the rate rises, because many of you traders that are watching this right now would not have seen rate rises, not have seen rate hikes from the Fed, and probably have just referred to interest rates as one generic term, whereas actually there are many interest rates, as I mentioned. So don't get caught out by that, because as professional traders we need to be professional in not only how we trade but how we prep, and not to make silly mistakes that essentially other traders will make. We are a smart bunch here. We are ahead of the game here, and it's because we prepare for such events that we do well. So please take that away from today, because this is something we haven't talked about before, the mechanics of the rate hikes, rate rises, and obviously use all this information that we've covered day to plan ahead of your potential trades for tomorrow. So tomorrow, unfortunately, I will not be doing the FOMC trading day actual trade plans or market structures. Richard Bailey will be doing that tomorrow at 4:45. But from me, I hope you found this useful, and please prepare and trade well and professionally tomorrow. Thanks very much. Have a good evening.